Okay, so welcome to our retirement planning webinar this afternoon. My name is Rita Svensson and I'm the Regional Manager for Australian Catholic Super based in Port Macquarie. And presenting with me today, I have one of our financial planners, Tina Tran. So welcome, Tina.
Thank you, Rita. Welcome, everyone.
And behind the scenes, we have Justin Colley, our moderator, and Justin's also looking after our chat facility. So please direct any questions to there or the Q&A, and we will endeavour to answer those questions, time permitting, at the end of the webinar. If we don't get the time today, we will certainly get back to you over the next couple of days. So some of the topics that we will cover today in the webinar will be: how much do you need in retirement, the tax benefits of superannuation, contributions to super and the associated limits, when you can access your super, allocated pensions and transition to retirement pensions, the government age pension, and we'll also give you an update on the legislative changes from the 1st of July this year. And certainly, and not last, how we can help you with your retirement and also your superannuation in general. So before I commence, I would like to acknowledge the traditional custodians of the land on which I work and live, and recognise their continuing connection to land, water and community. I pay respect to elders past, present and emerging. And before we commence, we need to go through the disclaimer that today's information is of a general nature only and does not constitute personal financial advice. You can find our product disclosure statement, financial services guide and other documents on our website at catholicsuper.com.au. So when we talk about retirement planning, one of the most important things that you need to consider is your own personal retirement goals. There are some items up there you can see on the screen that most people in retirement would probably have as goals, but it's really important to think about this because that will really drive how much you actually need to actually fund that retirement. So Tina, I know talking to a lot of retirees in your work, I guess they have a lot of different goals in their retirement.
Certainly different goals in terms of when people would like to retire and what they are definitely going to be doing in retirement. And that could revolve around traveling, spending time with family, as some of those icons indicate some of the themes that retirement encompasses for many of our members. And having a clear idea of what your life's going to be like will really help to work out how much funding you might need. And that's going to help us help our members with regards to planning for it.
Thanks, Tina. So the Association of Superannuation Funds of Australia, ASFA, do a quarterly survey around the country in all the capital cities of what retirees actually do spend in retirement. And they have come up with what's a modest lifestyle, a comfortable lifestyle, and also against the full age pension. And before I get Tina to explain a bit more about the actual figures here, it's very important to note that they are based on the fact that a person does actually, or a couple, they do actually own their own home. Thanks, Tina.
The basis of where these numbers originated from does have the assumption that you own your own home, so you're not paying for rent, and that you haven't got any financial dependents that you're supporting. So, you know, it's pretty much the cost of running a home, one vehicle if you're a single or a couple, and your health for the comfortable lifestyle. That includes the cost of having private health cover, whereas not included in the modest figure. And in regards to lifestyle, a comfortable retirement lifestyle is going to have more discretionary money available for lifestyle spending. And if you compare that to the full age pension, you can see that the comfortable retirement figure for both single and couples is quite a lot higher than the full age pension. So it's going to certainly give you a lot more money to have fun in retirement. So that's really what we're helping members to achieve, is to be able to have that comfortable retirement. The other thing is that those numbers are averages. They're benchmarked based on an average. And I think where I noticed the key differences against these averages would be, for example, in the comfortable retirement estimate, there is provision in there for travelling. But it's not an overseas trip every year, for example. It's every 2 or 3 years. So if your retirement goals are to be able to spend time overseas every year, at least, you know, for the first 10 years of retirement, you're going to need to bump up that goal a bit more. On the other hand, maybe you don't want to be traveling overseas that much, or maybe not at all, and it's mostly domestic travel or spending time with your family, then it is possible that your comfortable figure is slightly below the average comfortable. What's important is that when we're helping members with retirement planning, we ask them to give some thought about what life's going to be like, and that's going to give us the ability to best help you quantify what you might need against these averages.
Thanks, Tina. But certainly superannuation isn't the only asset that's considered, I guess, in funding your retirement. That would be correct, wouldn't it, Tina?
It certainly is. I mean, superannuation would be, for most people, one of the largest assets that will contribute towards funding retirement. However, when we're looking at retirement planning, we're going to look at the whole picture and identify all the resources that you might have available. So that could be, for some people, some savings built up in their bank accounts or in term deposits. It could even be some shares that you've either inherited or acquired yourself, or maybe acquired as a result of holding some insurance policies in some companies that have demutualized, or it could be an investment property that you've purchased along the way. And of course, last but not least, which a lot of people may or may not have considered, is the family home. Now, that's not necessarily the case for a lot of people if they're going to continue living in their home, but it could be a possibility if it was part of your plan, or maybe it will be part of your plan down the track to downsize, and there may be some surplus money as a result of that. Sometimes that happens because of a change of situation, and sometimes that could be part of the planning strategy.
Excellent, thanks, Tina. So superannuation, though, is still a very tax-effective way of trying to build that retirement nest egg. As you can see there, in the superannuation phase or the accumulation phase, the investment earnings behind the scenes are taxed up to 15%. And so your superannuation guarantee contribution, so that 10% that is paid in by your employer, and any salary sacrifice contributions, are also taxed at 15% by the superannuation fund. And then, of course, transition to retirement. Tina will talk about that a little bit later, but the investment earnings there are also taxed up to 15%. But then when you actually get to actually retire and say set up an allocated pension, well, the investment earnings behind the scenes are tax-free, and any pension payments you receive are also tax-free. So a very tax-effective structure, superannuation. So talking about tax, one of the best ways to build that superannuation balance is by making pre-tax contributions or salary sacrifice contributions. As you can see in the table there, most people are in the $45,000 to $120,000 income bracket. So your marginal tax rate is 32.5%. So when you direct some of that money, instead of into your bank account, but to your superannuation fund, those contributions, as I mentioned just before, are only taxed at 15%. So you have an instant tax savings of 17.5%. And that's without taking any risk whatsoever. And obviously, as your income increases, your marginal tax rate increases, so the tax savings are greater. But if you are earning, let's say, under $18,000, well, you're not paying any tax, and potentially making salary sacrifice contributions may not be the best option for you. You may then consider making after-tax contributions. We have here an example of someone making salary sacrifice contributions. Tina, could you take us through that?
Definitely. This example here can give you a clearer picture of how the numbers work. In this example, we've got a salary of 100,000 fortnightly equates to 3,846. So that's your first line there. And on the left column is the net take-home pay after tax. On the bottom, $2,884. So your payroll would have already taken tax out based on that gross fortnightly amount, and that's the net amount that gets banked. On the right-hand column, we have the example of instructions to salary sacrifice 5%. So what would happen is 5%, which is $192, would go into your superannuation account, and your taxable income will be the lower amount after taking that off. So that's 3,653. And income tax is applied to the 3,653, resulting in a take-home amount of 2,757. So your net result is you get 2,757 in your bank account, and you have money going into your superannuation account, which is represented by the 192 less the 15%, which is an extra $66 more than you would have got if you took it home. So the difference is tax savings of $66 per fortnight. That's going into your hands in your superannuation account, and quantify that in terms of a whole year at 26 fortnights, you get an annual amount of 1,716, and a simple 10-year calculation of that gives you $17,160, and that's not even including the earnings compounding on that amount over that period of time. So a little bit of salary sacrificing over time can make a significant difference in the balance of your superannuation, which will end up in your hands at retirement.
Excellent, thanks Tina, certainly tax effective. Okay, so your superannuation guarantee contributions, so that 10% being paid in by your employer, any salary sacrifice contributions you make, any personal deductible contributions are all called concessional contributions, and they all have the one limit, and that limit this financial year is $27,500. And as I mentioned before, they're all taxed at that 15% on entry into the superannuation environment. Now, there happens to be what's called a carry forward rule. So Tina, can you explain a little bit about that as it relates to concessional contributions?
So the concessional contribution rules capped each year of 27,500. There were some changes brought in 2017-18, whereby under certain conditions, you could carry forward, meaning you can use your contributions that you didn't use in a future year. So you're carrying it forward into the future to use. The conditions are that it means you have to have, this is where your superannuation balance is under 500,000 in the financial year preceding. And so it's important to check that you qualify for the rules. So two things. Firstly, that you qualify in that your superannuation balance is below the threshold. And secondly, that you have some unused concessional contributions from previous years, which is 2017-18, or even the subsequent years to that, available. Then that will add to the current year cap. So you could go over the current year cap because you've got previous years available cap to carry forward. And that's can be very confusing because, as I said, for a lot of people, it may not be available. And sometimes payroll might alert you that you are over the annual cap, But if you've sought advice and you know that you have carry forward available to use, well, then that's okay. But certainly important to make sure that if you're making contributions, you don't go over the concessional cap, whether that's just the annual cap or the annual cap plus any carry forward you may have available.
Thanks, Tina. Certainly could get very complicated, so important to get some advice in that area for sure. So then you can also make after-tax contributions to your superannuation. So they are called non-concessional contributions. And those contributions are not taxed in the superannuation environment and also on withdrawal because you've already paid tax on those. So the limits are very different. Under the age of 67 at the moment, that limit is $110,000 per financial year, but you could potentially bring forward another 2 years worth of contributions and contribute up to $330,000 in one financial year. But then you could not make a contribution for the next 2 financial years. And currently, if you're between the ages of 67 and 74, your limit is $110,000, so you don't have that bring forward provision available to you, and you must meet the work test. And that work test is just working 40 hours over a 30-day period in the financial year. But if you're over the age of 75, then you won't be able to make these type of non-concessional contributions. And a little bit later, we'll just explain as well that things are changing from the 1st of July in this space. So essentially between 67 and 74, you will be treated the same way as if you're under age 67. So you won't have to meet the work test and also be able to utilise the bring forward provision. Okay, so there are other ways to contribute as well, in particular the downsizer rule. Tina, could you take us through those, please?
The contributions into superannuation, if members are sort of getting confused, is to think of where the money is coming from, then identify which cap it falls under. So the first one we talked about was the concessional contributions, and that is for contributions that is sourced from your pay through employer contribution, salary sacrifice contribution. It can also be sourced from your own personal contribution when you claim a tax deduction. Then we have the non-concessional contribution, which is coming from an after-tax cap, and that could be your own personal contribution that you've made, or it could be even contributions you've asked your employer to put in from your after-tax income. Lastly, I mean, there's more other contribution caps, but the one that's most relevant for our members, in addition to those two that I just mentioned, is the downsizer. And the downsizer was brought in a couple of years ago, made available for anyone over age 65 years of age who downsizes their home, sells their principal place of residence, and they're able to make contribution into superannuation under the downsizer cap. So that is a different cap from the non-concessional cap. Again, 1st of July 2022, there's some changes to the downsizer, not so much in terms of being able to contribute, but making it available to younger members. So we'll confirm that and talk about that in the later part of this webinar. So you've got concessional contributions, non-concessional contributions, downsizer contributions. What are some of the, what's the other one? Spouse contribution. A spouse contribution is essentially a contribution in which one member of a spouse makes to another member of the spouse. That doesn't actually have a separate cap. It falls under the non-concessional cap. But why would it be needed to be recognised as a spouse contribution? That's because the government's given some incentives, a tax rebate incentive to contribute to a spouse account. And that's rebate is only available where the receiving spouse is a low income earner. So the contributing spouse gets a tax rebate to put money into their low income earning spouse. super account. And the idea around that was to help boost the superannuation of the partner that's not earning as much, who may not have as much in superannuation. And again, if you're not sure in terms of whether there's benefits or whether you should, then please seek advice. We can certainly help with that to make sure that firstly, it is not in breach of any caps and that you may be eligible for that tax rebate.
Excellent. Okay, so now we'll talk about when you can access your superannuation. I get asked this question a lot by our members, and essentially the answer is when you reach your preservation age and meet a condition of release. So as you can see there, if you're 58 or 59 and you have genuinely retired from the workforce and not going to work more than 10 hours per week, then you can access your superannuation. If you're between the ages of 60 and 64, you need to cease an employment arrangement. So maybe you have 2 jobs and you cease employment with one of those, well, then you could access your superannuation. But once you reach age 65, you can access your super whether you are working or not. And if you access your superannuation, you don't have to take a lump sum. You can certainly set up an income stream, like an allocated pension, or could actually do both. So just to explain how the 2 different accounts work. So in your working life, you have a superannuation account. That's where all your contributions go into. So they're all accumulating in that account, just like we've been talking about all those contributions. And eventually when you retire, well, you set up a separate, let's say, allocated pension account, and that's where you can set up to have regular payments, pension payments paid into your bank account. That could be weekly, fortnightly, monthly, quarterly, half yearly, or even yearly. And then you can also access lump sums from there. And as we've spoken before, the investment earnings behind the scenes are actually tax-free. But if you do want to keep doing some casual work, you do need to have a super account open because you cannot contribute to a pension account. Now, I mentioned transition to retirement pensions before. Tina, could you take us through how a transition to retirement pension works, please?
So, Rita, you've just talked about the superannuation accumulation account and then the retirement pension account. The way to look at it is that they both sit under the superannuation umbrella and they're at a different phase. So in the superannuation account, you're in the accumulation phase. Money is being contributed and going in, and all the investment earnings are accumulating. In the pension account, there's now a tap on it and there's a flow of payment coming out of the account. The transition to retirement pension is the same account in that it's still like the allocated pension in retirement that has the tap in it that you can receive an income payment. But the key difference is that you're able to start a transition to retirement pension even if you haven't retired, subject to having reached minimum preservation age, okay? And in that situation, the transition pension allows you to grab your money from your super by way of a transition pension and receive it as a regular income. The reason for doing that could be a number of reasons. In terms of advice, sometimes we are setting up and providing a recommendation to set up these type of transition pensions for members who may want to move into part-time work, and as a result, their wages are lower and they need to maintain income to meet their living expenses, but they're not fully retired. So the transition pension is a way in which they can supplement their income and be able to still meet their requirements, even though they may have dropped in hours in terms of work. The other times we might use this transition to retirement pension product is to be able to facilitate extra income so that a member maybe has more cash flow to accelerate debt repayment if they're carrying debt and they want to try and pay down their debt as fast as possible. Of course, that means that their superannuation isn't going to be growing as fast, but at the same time, they're going to be able to pay down their loans faster. So that could result in a better net outcome. And lastly, there are circumstances where members are not able to afford to use up all the concessional contribution cap and salary sacrifice up to the cap, which gives them the, I guess, the most effective tax savings in terms of structuring their wages. Well, one of the strategy we use the transition pension to supplement income so that the salary sacrifice can go up to the maximum. The benefit of that result is that you're going to get more into superannuation without reducing your take-home pay. So there's a number of strategies that we would consider a transition to retirement pension, but it's not necessarily suitable for everyone. And it really is assessed based on the personal circumstance. For example, if you're under the age of 60, your transition pension is taxable as a pension income. So it isn't going to give you any tax savings to start it up if you don't need the income. And that's the same hand even if you're over 60 years of age. Even though the pension income is tax-free, if you're creating more cash flow that you don't need or spend, you haven't improved the outcome. So there are circumstances where it is very suitable and it can be utilised for different reasons, and that includes debt reduction, enhancing the growth, enhancing the build-up of super to be able to maximise your super contribution, and or facilitate the ability to drop your income by reducing your hours and still be able to meet your needs. So those are some of the examples. If you're not sure, again, we provide personal advice and we can assess its suitability for members.
Excellent, thank you, Tina. And then, of course, we have the full allocated pension. Can you take us through that as well, please, Tina?
The allocated pension, in this case we're referring to, is the one that is set up on meeting a retirement condition of release. So the difference with this is that you have now met the retirement condition and you have unrestricted access to your superannuation. And at that time, you can choose to create an allocated pension. And one of the key difference with an allocated pension in the retirement phase in comparison to the transition to retirement phase is that there is no restrictions on how much income or lump sum you can withdraw. So you can withdraw as much as you like, as long as there's money there. And the benefit of the allocated pension also is that all the investment earnings are tax-free. So there's a bit slightly more returns in your pension account on average than there would be leaving the money in the accumulation account. But keep in mind that you cannot make contributions to an allocated pension. So it is created and coming from a superannuation account that you have built up and transferred across to the allocated pension. The other thing that might be, I guess, an area of confusion is the allocated pension has no tax on the investment earnings. When the pension payment's received by you as a pension payment, it is tax-free from the age of 60. But if you are starting an allocated pension before the age of 60, it is considered taxable income with a 15% rebate. I'm not seeing too many people retiring before age 60 at this point, but that doesn't mean it's not possible.
Excellent, thanks, Tina. Now, we do have two different types of products at Australian Catholic Super. The first one is Retire Choice. Could you take us through how that one works, Tina?
So Australian Catholic Super offers two allocated pension to choose from. The Retire Choice allocated pension allows you, as the name indicates, an investment choice. And you'll see in terms of the investment choice that's available, you've got the diversified options. These are diversified portfolios that range from conservative through to more aggressive options. And then we have this single asset options, which invest in only the single type of assets. And it is then possible for you to build a portfolio with a blend of either just the diversified or both diversified and single assets in any way, shape or form you like. Of course, it can be confusing. So in terms of how we help members with this is we try and understand what their risk profile is, and then we put a recommendation on the investment choice that best serves their risk profile. And you'll also notice that these investment options are pretty much exactly the same as the investment options in the accumulation account, with the only difference is that there isn't the lifetime options in the pension account.
Excellent. And then, of course, we have Retire Smart.
Retire Smart is the other allocated pension. Now, I would point out that they're both allocated pensions. So in that regard, it's the same in regards to having the ability to draw pension payments and varying it and making lump sums, and that's tax-free. So the key difference is how the money is invested. That's the key difference between the Retire Choice and Retire Smart. So unlike the Retire Choice, in Retire Smart, the investment strategy is a two-bucket investment model. There are two buckets, is a cash bucket and the other bucket being the growth bucket. The growth bucket is the diversified portfolio with shares and property, but in with more growth in it. And the way it's set up is that your selected pension payment, that is how much pension income you're requesting when you open your Retire Smart account, will determine how much will go into the cash account to start with. And it's 2 years of your pension payments will go into the cash bucket, and the balance of the money will go into the growth bucket. You can see with that in the growth bucket, you're going to have investment earnings. So we call that the cash distribution. It's going to be paid into the cash bucket. The cash bucket will be where all your pension payments will be coming out of. And in regards to the ensuring that there's enough money in the cash bucket to pay your pension payment, it's getting distributions from your growth bucket. If there's insufficient distributions to pay pension payments, then the fund will automatically rebalance and sell down growth assets to top up the cash account. But on the other hand, if the cash distribution is greater and your cash bucket has increased greater than it's required to pay pension payments, then more will be taken out to reinvest in the growth asset. So that is a dynamic process, and that's happening behind the scenes. And that allows your monies that are going to be sitting there for longer to be earning as much as it can in growth assets, but ensuring that there's sufficient cash in the short term to meet pension payments without selling down growth assets.
Excellent, Tina. So we have spoken about how much you may need in retirement, how to build your superannuation balance. I guess the next question you may have is, well, when can I really retire and how long will that money last? So Tina, I guess this is really something that you cover a lot in retirement planning.
Certainly is. That's what I would call the $1 million question. The $1 million question also is something that people seem to have floating around, that you need $1 million to retire. And that can be true, and it can be not necessary too, depending on how old you are when that happens and how much you're going to spend in retirement. So one of the key consideration in understanding when you can retire and do you have enough is to be clear on how much your retirement needs are. And that's made up of two elements that I look at, is the ongoing regular living expenses. So that should be something that you could reasonably quantify over the course of 12 months. That would more than likely continue to occur on a consistent basis in the next, for the next 10, 20 years of your retirement. And then there's the irregular that might occur, which could be one-off lump sums. And if you can quantify or best estimate what those amounts might be in today's dollars, then we've got tools and calculators and that we can help members to tailor those calculations to their own personal situation. But there are also some average figures floating around. And as I said, the $1 million is one of the figures that are floating around. But I can show you this example that's coming up, that you don't necessarily need $1 million if you're going to be retiring a bit old at a bit later in age. So in this example, we have a couple who are both 65 years of age, and they have $300,000 in superannuation each. So that's a total of $600,000. They're homeowners, and they are going to target $63,000 per annum expenditure, which is pretty much close to, or if not at the ASFA comfortable figure. The inflation rate that will be assumed in our calculation is 2.5%, and the rate of return that we've used in our calculation is 5%. The inflation figures that we use means that we are assuming that the 63,000 spend will need to go up by 2.5% each year to buy the same cost of, to be able to meet the same cost of living. Okay, so the projections that we run are trying to be as realistic as we can in including the rising cost of living, and of course making an investment assumption, investment earnings assumption on the superannuation money. And I think using 5% is fairly conservative. So in this calculation with those figures, it also includes eligibility for age pension in that calculation. And you can see that the 600,000 is gradually going down over time, but it's lasting over 20 years. So in this case, that the couple with 600,000 is able to meet a retirement expenditure of $63,000, but it is coming from a combination of both their own superannuation money as well as age pension. And that's where this next graph is illustrating the proportion of how much they are funding and how much the age pension is funding. In this example, the eligibility age for age pension is 66.5, but the couple are is retiring a year earlier. So in that first year, they are fully self-funded. So they're using all of their superannuation to meet that 63,000. But in the subsequent years, we can see that the age pension picks up that cost of living for them almost as it gets up a little bit more than half of that $63,000, and their superannuation is funding the other proportion. And that's represented by that purple bar. So the red line is the $63,000 spend line, and the bars indicate the source of income. So the blue is the age pension and the purple is the allocated pension. And we can see that allocated pension being fully used up at around age 93. So in this example, it shows that it is possible, if you are working as close as you can to get to eligibility age of age pension, that is possible to meet a comfortable retirement with approximately $600,000. Of course, there's a lot of things and that could be variable in here. So that's where personalised advice can tailor that projection a little bit more for the individual members.
And it's certainly true that most people really will qualify for the age pension at some stage, won't they, Tina? Yeah.
I mean, even if this couple had 800, I mean, you still qualify for a pension up to a certain threshold. I'm going to go through what those upper limits are for the age pension. But even if a couple retired and weren't eligible because they had too much assets, it may well be that they're using up their assets and then at a later point in time, they come into eligibility.
Yeah, absolutely. Well, that's sort of timely now. I will get Tina to take you through the next lot of slides on the government age pension eligibility and assessment criteria. So over to you, Tina.
So the age pension, first criteria is you've got to be the eligible age, of course, and then there's a means test. Of course, you have to be a resident of Australia residency, but there's an assets and an incomes test, and that will drive how much the payment you'll get. So with regards to eligible age, for anyone born after 1950 or 1st of January 1957, it's 67 years of age. This is for both males and females. There was a difference before, but I think women wanted equality and we got it. So maybe not this way. So it is the same for male and females. And then if you're born 1 July 1955 through to 31st December 1956, your eligibility age is 66 and a half years of age. So this is firstly the first sort of hoop you've got to pass is you've got to be eligible age first. Then there is a means test. I'll explain the assets test first. The assets test is a measure of all of the assets that you own, with the exception of your principal place of residence. And this slide here has the asset limits for a single person who's either a homeowner or a non-homeowner. So you can see the non-homeowner asset limit is higher, because it's a recognition that if you're renting, you're going to need more assets to at least generate some investment income to pay rent, and so they've given provision for a higher asset threshold. The upper threshold basically means you don't qualify for any payment. The lower threshold means you get the full payment, and somewhere in between you're getting a part payment. And that's the same sort of criteria that works whether you're a single homeowner or non-homeowner, or a couple homeowner or a couple non-homeowner. Just the numbers are different. Okay, so in this slide we've got a couple homeowner. If you've got more than 901,500 of assets, you're out of that eligibility range. If you're in the middle, you're getting a part pension. If you're below the 405, your rate of payment is full pension. Now this test is then also going to be compared against the income test. And the income test is a measure of all the income that you would possibly generate from your assets, or maybe generate from work. So it's income that's coming from assets or income that's coming from work income. Add that together, and again, there is an upper threshold and a lower threshold. In the upper threshold, if you're outside, above that, no pension. If you're in between, part pension, and if you're below the lower threshold, you got a full pension. So how does it work in terms of the comparison of the age, the assets test and the incomes test? Centrelink will calculate your rate of age pension eligibility based on both tests, and it's the test that gives you the least eligibility or no eligibility will be the overriding test. So an example would that be where the tests can override each other. For example, is that you could be you could be asset rich and income poor, and you could be asset tested out of the age pension, or you could be under the assets test but over the incomes test, in which case again you would not be eligible for the age pension. So that's how those two tests work in conjunction. The main thing with the tests is that the principal place of residence is not included, but pretty much everything else is. Okay. Now, what is the rate of payment that you would get? This slide shows here what it would be for the maximum payment. We've got the single rate, 25,677. There's the couple rate, which is a combined amount of 38,708. Each person would get 19,354. And if you're a couple, but you're separated due to ill health, you get the single rate. So a couple individually don't get the single rate. They do get a lower amount, but if they're separated by ill health, they would get the single rate each. Now, what if you are in a, you've sort of saved retirement and you've got more than enough assets or even income to be eligible, and you're a self-funded retiree? Well, there is a Commonwealth Seniors Healthcare card available to you. So this is not the pension concession card, but it does give you some discounts on health costs. Now, the Commonwealth Seniors Healthcare Card is available for people who have reached pension age but are not eligible for an age pension, either because they're asset tested out or income tested out. In this case, if your income tested out, there is an income test on the Seniors Healthcare Card, but it's much larger income test than the age pension. Here on the bottom corner, you can see the single income limit is $57,761 per annum. And for the couple, it's $92,416 per annum. So if your income falls below that, you would be eligible for the Commonwealth Seniors Healthcare Card. There is no assets test. The other thing I would mention is what is assessable income is not necessarily what you draw out from your allocated pension payments. That is not the assessable income. The methodology that Centrelink uses is a different methodology. So just simply adding up all of the income you're getting from your pension is not the figure that is measured against this income limit for the Commonwealth Seniors Healthcare Card. It is a much lower amount that would be the actual assessable income. It's under a deeming calculation. So that's something that a lot of people may not be clear about. The Commonwealth Seniors Healthcare Card is available for a lot of retirees.
Excellent. What
else can you access? So some states or territory governments also offer, for example, in New South Wales, the New South Wales Seniors Healthcare Card, not Healthcare Card, the Seniors Card. And the Seniors Card can give you some discounts on public transport and utilities, and some businesses will offer discounts for seniors. So that all goes towards reducing your cost, which will help towards being able to have that comfortable retirement at a lower cost. And lastly, in regards to advice, we've talked about, contributing to superannuation planning for your retirement. Estate planning is probably one of the things that we don't think about. And in terms of superannuation, it's very easy for you to ensure that your superannuation goes to the right beneficiaries by making a nomination of beneficiary. The nomination of beneficiary that you make will tell the fund who you want the money to be paid to. And it is also available for you to make a binding nomination. And this is where some people often ask, what is a binding nomination? Well, in superannuation, it's a trust structure. When you make a nomination to a beneficiary, the super trustee will honour that nomination. But if it's not a binding nomination, there is an obligation to consider the validity of your beneficiary nomination, particularly if there's a challenge to that. So if you want to make it certain, then make it a binding nomination. And with a binding nomination, on your form requires you to have 2 adult witnesses, and that will make it a binding nomination. But it also will expire after 3 years, so you need to re-nominate that every 3 years. And that will help to ensure that your superannuation goes to who you want it to go to as efficiently as possible. The other areas of estate planning is making sure that you've got a valid will, which directs, and again, the payment or distribution of your other assets that's not outside of superannuation, because superannuation is outside of your will. And with regards to property, for example, if it's in individual names, then the will ensure that it goes to the right beneficiary. And lastly, if you have, if you're in a situation where you may lose mental capacity to make decisions, financial decision, having a power of attorney set up is also important. And that ensures that you've chosen someone that you trust who can make these financial decisions for you if you are unable to make one yourself. And these are all part of ensuring that your financial things are in order should you lose decision-making capacity or in the event of death, your funds go to the appropriate beneficiaries.
Thank you, Tina. Certainly a lot to consider. So just talking about covering off what the changes are from the 1st of July this year with regards to legislation. So currently there is the 50% reduction in the minimum drawdown requirements for pensions. So that's been extended for another year through to June 2023. If you earn less than $450 each month, then your employer will now need to also pay superannuation guarantee contributions on that money, and the SG rate is increasing to 10.5% for all employees from the 1st of July this year. So some of the other changes, Tina, I think we've spoken about a little bit.
We certainly have. So this makes, in some way, superannuation easier to understand in terms of contribution rules. The need to meet the work test has been scrapped, which makes it very easy. It's an age-based kind of rule. If you're under 75, you can make contributions into superannuation. And the other thing you must, of course, take into account, even if you can make contributions, is to make sure that you stay within those caps. So eligibility is easy. Contributing, need to make sure you don't go over the caps. The bring forward is available as well. So again, that makes it easier in that if you're under 75, you can contribute and you can bring forward. The downsizer contribution, they've made it available for a younger age group from age 60. So if you are selling your home and you have surplus funds, you can contribute under the downsizer, even if you use the other caps. And lastly, with regards to the first home super saver scheme, that's been increased to allow the first home buyers to withdraw up to $50,000 of voluntary superannuation contributions to go towards their first home deposit.
Yeah, thanks, Tina. So how can we help you with Australian Catholic Super? So first of all, it's what's called general information. That's the information that I can provide you with any of the regional managers and also the call centre. So that's really explaining the rules and regulations for you, assisting you with any forms that you may need help with. So please, contact us at any time. We're always here to help. But if you then say to me, Rita, which investment option should I be invested in? Well, that's when I would direct you through to our limited advice service. So this service is at no additional cost. It's part of the membership fees that you pay with Australian Catholic Super. It's over the phone service. And essentially, the financial planners there can provide you with advice in three different areas. We spoke about salary sacrifice contributions and after-tax contributions, so they can actually do some calculations for you. Maybe you'd like to maximise up to the concessional contribution cap, so they can help you with that. If you we have 14 different investment options, so they can actually do a risk profile for you and make a recommendation as to which investment option or options you should be invested in, and also looking at what insurance cover you have within the fund and making sure that is adequate for your own personal circumstances. But then, of course, Tina has spoken a fair bit about a lot of information today. So Tina is our next level advice, providing comprehensive advice to our members and non-members. So Tina, could you run us through what you can cover in that advice, please?
Well, comprehensive advice service essentially looks at everything. So if you are planning for retirement, for example, we'll take into account consideration of all assets and have a look at the short-term as well as long-term strategy. And that could include a debt repayment strategy if you're still paying down debt. It could be looking at investing monies in superannuation if it's tax effective, and that's an effective way for you to build up your retirement savings. But in some instances, it could be advice to invest outside of superannuation, and this could occur whereby you've already reached all your caps and you cannot contribute anymore, or it could be that you're a long way off retirement and you want to build up some savings for a future event that you need access to. So that could be taken into account. And lastly, with regards to sort of more retirement planning type advice, obviously if you're approaching pension age, and it could be one member of a couple or both reaching age pension, then we're going to look at how we can set up things to structure it to maximise eligibility if it's within obviously the situation that suits your circumstance, and have access to Centrelink to help support your retirement. So it's a much more broader look at your overall situation and advice on that.
Excellent, thank you, Tina. So I just want to bring your attention to our member portal, so you can actually access your account online. If you haven't registered already, just go to our website at catholicsuper.com.au, go to the login button up the right-hand corner, and then just follow the prompts and register for access to your accounts. You will need your client ID. And then when you can have access, you have a lot of information there. You can do a lot of things. You can have a look at your superannuation account balance, your pension balance. If you have both accounts, you can do switches. You can make a nomination of beneficiary on there, but not a binding one. You can also print off a Centrelink schedule. So there's a lot you can do there. So I do encourage you to actually get access. And we also have an app. Okay, so just summing it all up, I just mentioned the member portal. I do encourage you to register on our member portal for online access. Certainly, please give your regional manager a call at any time. We are here to help. And certainly our different advice services as well. We're all just here to help you with your superannuation and your retirement planning. Just last of all, quickly, our contact details. We have our 1300 number there. Our website is catholicsuper.com.au, and you can follow us on the social media channels if you so wish. And I think now I will hand over to Justin to see if there are any questions. Thanks, Justin.
Thanks, Rita and Tina. Very informative session tonight. We have got a number of questions. Some of them are bordering on personal advice, so we'll revert to calling those members tomorrow to give them those answers. But the first one I will head Tina's way. Tina, is the $300,000 downsizer contribution counted in determining the eligibility for the age pension?
Okay, the downsizer contribution is not the measure of assets. What is measured is the value of the superannuation balance, or the value of the allocated pension balance for the person who is pension age. So it's not the contribution we're talking about. Obviously, if the contribution is gone into superannuation, then it's boosted the balance. So in that way, yes, it is assessable because the balance is what's assessable. However, if the situation is that if the balance is in the superannuation account for a member of a couple, the member that is not yet pension age, the money that is in the superannuation account is not assessable against the member that is pension age. But if that super money is in the person that is pension age, then it does count. Okay, so the answer is actually not yes or no. It depends on where the money is and who it belongs to and who is pension age or not.
Great, thanks, Tina. It's probably good to get advice on that.
Yeah.
The next question I'll go to Rita. This lady has asked, I am 61. If I retire and then access super via pension, can I then go and work casually?
If you do retire and you decided that you had retired, you can actually, you need to have a break in that service though. You could potentially go and do some work after that, but the tax office doesn't have an issue. Sometimes people also change their mind, but I would certainly make sure you do retire first of all, and maybe down the track you could do some casual work.
Great, thanks, Rita. The next question I have is, can you contribute a lump sum each year?
Yeah, you certainly can make a contribution. Just remember, firstly, that any contribution you make each year is measured against the cap that's relevant for that contribution each year. So it's not so much about can you contribute each year? Yes, you can, as long as you haven't gone over the caps.
Great, thanks, Tina. And the same lady's also asked, if you change from 5 days working to 4 days working, how much does that affect your super?
So your superannuation contribution, what your employer puts in on your behalf, is a statutory, I mean, at the moment it's 10%, it's going up to 10.5% from July. So if you drop wages, then your super contribution will also drop because it's on a lower wage. How does that affect the accumulation of your superannuation in the long term? Of course, you will be accumulating at a smaller amount, and so it will take you a bit longer to achieve, you know, the amount of super you might be targeting.
Thanks, Tina. And the last question we'll answer tonight is, and I'll hand this your way, Rita. Do you have to prove that you are retired? Is there a document you need to complete?
We do have a, what's it called?
A statutory declaration.
A stat dec form that you can complete for us to actually state that you have retired, yes.
I think the main thing people sort of sometimes ask me when they're seeking advice is that it is a declaration you are making. The fund does not ask you for some sort of letter or anything like that. So when you are accessing your superannuation under a condition of retirement, then you're making the declaration when you access it that you are meeting the retirement condition.
And all superannuation funds ask you to make that same declaration.
Correct.
Yeah.
Yeah.
And I did say it was the last question, but this was a question that came in as well, and it's just more of a housekeeping issue. So I'll ask the question and answer it myself. Is this session being recorded? And the answer is yes, it is being recorded. We're actually out being, live streamed into Facebook at the moment as well. So this session is being watched by people on Facebook, and you can go back to Facebook and watch a replay of that. Also, it will be on the fund's webpage or through our YouTube channel in about the next 24 to 48 hours as well. So that's it as far as questions go. So I'll hand it back to Rita and Tina to wrap things up. Thank you.
Okay, thank you very much, Justin. And thank you, Tina. It's been a very informative session, and I hope everyone has enjoyed it. And, you know, please, you know, contact us for any assistance. So thanks again for joining us tonight.
Thank you. Have a good night.